Today I would like to talk to you about investments. And the first one will be investments in debt securities, which is your bonds. We will be covering trading and available for sale because they use the same method, cost. Held to maturity bonds are long term, and we will not cover it in this class. Assume 123 Company, fiscal year ending December 31st, purchased a debt investment on April 1st, 2013 for $50,000, paying an extra $1,000 commission, a brokerage fee. It also receives $2,000 interest every 6 months on the investment. We will open a brand new debt investment account. Debt investment account is a regular asset account because it's a future benefit, future economic benefit, and therefore normal balance will be debit. I will debit debt investment for, now be careful, it's not only $50,000 that you're used to, but it's actually $51,000 because the commission will be also included. Do you remember that cost principle we talked about a little while ago? That's why whatever it took you to get that investment on your books will consider to be cost of that investment. I'm going to write really big cost. Okay, it becomes very important when we sell that investment a little bit later. And we paid cash, $51,000. Okay, here comes October 1st, and we received our first interest payment, so we're going to debit cash for $2,000. This time you got it easy. You didn't even have to calculate interest, but I could have given you the interest rate and interest revenue. Interest revenue, $2,000. Okay, here comes December 31st, and our next payment will not be until April. However, as of December, we are entitled to a receivable, interest receivable. How much? Well, half of the 6 months or 3 months have passed. Be careful, it's the whole October, November, and December. Therefore, we will record interest revenue. Interest revenue will be recorded for $1,000, half of your two. And instead of debiting cash, we will debit interest receivable for $1,000. Okay, here comes April 1st, and now be careful. You're still getting your whole $2,000, but it will come from two different sources. One of them will be you will collecting this interest receivable, and the second one you will record your brand new interest revenue for year 2014. So let's see what it would look like. So I'm going to debit cash for $2,000. Okay, you will credit, because you're collecting it and it's going down, interest receivable for $1,000, and then interest revenue for $1,000. Okay, here comes the sale date. On April 1st, 2014, you sold this investment for $65,000. If you sold it, you received cash. How much? Well, we told you it's $65,000. That part is easy. Now, be very careful. If you got rid of all the bonds, you'll have to go back and always double check what was in the original journal entry when you recorded at cost. Number one error on the exam is that you forget that commission and you automatically pick up 50,000 as your cost. However, your true cost was 51. And if I were to say that we only sold half of our bonds, you would have taken 51,000 and divided them by 2 and recorded as your cost reduction right here. So I will go ahead and write off or sell or get rid of or credit all the bonds, my investment, at $51,000. And it looks like I got a gain on sale for the difference. 65 minus 51 will give you $14,000. Okay, we're done. Well, our next big project is investment in equity securities, which is your stocks. It is very important to understand that your journal entries will be governed by the percentage of ownership and control. Well, if you owe 0 to 20%, it is agreed that you've got little to not control in the corporation. If you've got 21 and up to 50%, you do exercise significant control over the corporation. Therefore, you get to use equity method to record the stock investments, I should say. And then if you have more than 50%, I should say 51 up to 100, you have a dependent corporation, so you get to consolidate their financial statements with yours. I gave a very short overview of the methods, and then on the next page, please get your handout ready, separate page. I will go through side by side what's going to happen if you were to use cost versus equity methods. In my first example, you invested and bought 10% of all the stocks of X Incorporated. Remember, if you've got up to 20%, you get to use what's commonly referred as cost method. Cost method. What's going to happen? Very similar to what you just saw with debt investments. You will open stock investment account, not debt, but stock investment. Regular asset account, normal balance is debit. So we will debit your stock investment account, and in this case we paid $100,000 even. If you were to purchase the stocks and let's say you paid again brokerage fees, those will be included in the same fashion as you just saw with debt securities. So again, if you were to incur any kind of additional cost, you have to add it to your stock investment account. On the other side, as usual, you get to spend cash, so therefore we're going to credit cash for $100,000. All right, what's going to happen next? Well, that's your lucky day. X Incorporated pays a total, be careful, total cash dividend of $40,000. Since you only have 10%, your share of dividends will be only $4,000. So be careful. In some exercises, they tell you total cash dividend. In some, they will tell you your share. So be careful when you're reading what did they give you. In this case, you received cash, $4,000, and you received dividend revenue. Dividend revenue of $4,000. Okay? Now, if you were to look at these two journal entries, that's actually very much alike your debt securities. What are the couple of differences? We used to have debt investment and now we have stock investment, and we used to have interest revenue and this is a dividend revenue, but it's very much the same fashion. Now, X Incorporated reports net income of $160,000. What can you do? Well, your share is so small that other than rejoicing, there's not much you can do. Since we cannot record joy, there is no journal entry in this case. In my second example, you get to have 25% of investment. And just as in the first case, the company paid $100,000 for the common stock of X, the first journal entry will be identical. So we're still using, and we're still debiting your stock investment account, stock investment for $100,000. Again, if you were to pay any kind of brokerage fees, they will be added to your cost. So, in cash, $100,000. So beginning journal entry is the same. Now for the second one, when X Incorporated pays a total cash dividend of $100,000, so your share again will be how much in this case? 25% of it, or 1/4, $10,000. The next journal entry for this one will be kind of strange looking until you get the full picture of all three journal entries. So you actually received cash. Okay, you got $10,000. So far, so good. But the credit in this case will be stock investment. Okay, stock investment. Now bear with me until we go all the way to the end and you get to see the big picture. $10,000. Okay. In the very last journal entry, X Incorporated reports net income of $160,000. Since we are entitled to 25% of it, we treat it as if we got actually 25% of that net income. And net income, if you remember, will increase your equity. Why? Through the retained earnings. It will be close to retained earnings. Therefore, your equity will go up. So 40,000 of that will be yours, and it will be an increase in equity, your part of equity in X. Again, your part of equity in X. Remember, we're using equity method. So your share in retained earnings of X Incorporated just went up by a whopping $40,000. Your stock investment account is your magic tool to record everything that happens in your equity share in X. Okay? So if X's equity changes, your stock investment account must change as well. So stock investment just went up due to net income or retained earnings increase of $40,000. Okay, and then what do we report on the other side? On the credit side, we will use a brand new account that's called income from X. So that's your regular other revenue account. So it will be reported on your income statement. So again, stock investment went up by $40,000, and then income from X also increased. Now let's try to get the big picture of what just happened. X reported $160,000 in net income, so retained earnings went up by $160,000. When you pay dividend, if you remember, it is paid from your retained earnings. So overall, your net increase in retained earnings in X was $120,000. 160 minus 40,000 will give you 120. Since we have a 25% ownership, so 1/4 of 120,000 is mine. So $30,000. I can say that my equity stake in X should increase by 30,000. Again, my equity stake in X should increase by 30,000. Let's see. Stock investment was debited or went up by 40. Then it was reduced by 10. So I show an increase in stock investment of $30,000, and that's exactly what I should have had. As an overview, if you're using what's called equity method, if you're keeping track of accounts, it doesn't matter what the journal entry looks like. One of the accounts that is always affected under this method is your stock investment account. And here again, both methods side by side, it will be very beneficial to just ponder on the two and take a look. Cost method is very much alike your debt investments, but equity method is very much different. And usually that's where we get the most of the errors. But you'll do just fine.